It's Thursday, 17th of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the global EV sales picture and what that says about peak oil demand, and an exclusive clip from an online briefing following that ECB October meeting. But first, Neil Shearing, Group Chief Economist, is on the line from a departure lounge in Hong Kong after a week of meetings with clients in Asia. Hi there, Neil.
Hi, David.
Before you get your flight, I wanted to get your take on the US election because we're just over 2 weeks away from November 5th, and polling suggests this is still looking like a fairly tight race. You've been briefing clients on what to expect. By that, obviously, I don't mean who's going to win, but what the winner would bring to the table. Now, we had Trump's interview in Chicago earlier in the week, and he's freewheeling as usual. But he talks about pushing tariff rates of 2,000% on car imports from Mexico. He's talking about the highest tariffs in history. In our analysis, we've worked on this idea that Trump, if he's re-elected, will bring in a 10% blanket import tariff and 60% tariffs on imports from China as a base case, because, we need something to work with. But it has been very hard to pin down, what is Trump's trade policy? So what do we know about what Trump would bring if he came into office in January? And what are the global implications of that policy?
Well, the short answer is we don't know a great deal. And you alluded to that just then when you mentioned the interview with Bloomberg. We had anything from 100% tariffs on imports from Mexico to 2,000%. So take your pick amongst that. And it's been similarly mixed messages when we look at what has been said more broadly on the campaign trail. I think there seems to be support within his team for potentially pushing a universal tariff, which would represent a major departure from policy in the first Trump administration and since then. And it seems likely that China in particular is going to be the focus of tariffs. So I think the exact details of what makes it into a policy program is still unclear, but it's likely, I think, to see higher tariffs, particularly on China, and potentially a universal tariff too. Now, what are the global implications of all of that? Well, again, it will depend on the form that these policies take, but in general, if you're an economy that's more export dependent and particularly dependent upon exports to the US, then you have more to lose. So to the extent there are big tariffs incoming, the major losers are likely to be China, potentially Mexico, depending on how that plays out with USMCA members, Vietnam too, and some other East Asian economies.
So putting that together, in terms of global trade, were Trump to be re-elected, were he to introduce the levels of tariffs that we're talking about, what would that mean for the global economic outlook?
Well, I think one important point to keep in mind is that over the last 6 years, we've seen a steady incremental rise in average tariff rates across the global economy. And yet this year, we're on course to have a record year for trade volumes across the global economy. So just because we're seeing higher tariff levels, at the moment, those increases have been quite small and they've not translated into a big dip in trade volumes, which is why, as I come back to the point I just made, that the exact shape and form of this policy is going to be really important. If they're set at punitive levels and the US really embraces isolationism, then that's clearly a disaster for global trade and the global economy more generally. If there are more incremental shifts up in US tariffs, so it's perhaps a bit more manageable. And of course, there are much broader factors affecting patterns of global trade than just tariff policy.
So what I'm reaching for, I guess, is the historical precedent that we can draw on when we look at the kind of proposals that Donald Trump's talking about, tariffs in the hundreds of percent. There's a tendency, isn't there, to reach for Smoot-Hawley and the 1930s as an example of what could happen when tariffs go up at that level, at that breadth. But is that an overreach in terms of what we're talking about were Trump to be re-elected?
Well, I think the parallels with the 1930s are a bit limited, if I'm being honest, partly because the world's moved on. Most trade back then was in goods. Now it's goods and services. The shape of the global economy's changed as well. And obviously, the emergence of China as a peer competitor to the US is the major driver of this push to raise tariffs, rather than in the 1930s, it was the Great Depression. And and the sense amongst policymakers that what little demand there was, you wanted to try to divert to domestic producers. So the global economic backdrop, the geopolitical backdrop is very different today. There is a precedent actually for a universal tariff in the US. After the US came off gold in 1971, the so-called Nixon shock, it also imposed a 10% surcharge on all imports to the US, with one or two exceptions. That was pretty short-lived. So it's not like we can go back to that example, look at the data and say, well, here are the implications for the US economy and the global economy more broadly, because it was a short-lived policy. I guess more recently, the country or the economy that has raised trade barriers with its major trading partner has been the UK after the vote for Brexit. And if you look at the performance of the UK economy since then, it's pretty clear that exporters have struggled and the economy more generally has been one of the weaker performers within Europe. There's lots going on there. It's not just Brexit, but there's a lesson from recent history here, which is that trade barriers with your major trade partners are not good for exporters. They're not good for growth.
Trump's basic message seems to be that if you raise tariffs high enough, you encourage investment into the US by companies that want to avoid those punitive costs. Would that work in practice?
I think that's a complete misreading of the current set of circumstances affecting the global economy. The issue here is that China has emerged as a peer competitor to the US. It was supposed to become the strategic partner. You bring China into the global economy, it becomes politically liberal, more economically liberal, and that clearly has not. Alongside that, it's emerged as a peer competitor with an extremely high domestic savings rate, an extremely high domestic investment rate, and therefore an economy that's essentially reliant on external demand to drive growth. And it's doing that by investing in vast amounts in its industrial infrastructure and then shipping those products overseas. So you have two things going on. China emerging as a peer competitor to the US, but a peer competitor with an export-driven growth model. So viewed through that lens, it's not clear to me why the US would actually welcome vast amounts of Chinese investments in the US economy, because it would bring with it national security, supply chain security concerns. Also, it's not clear to me that would do a vast amount to really raise aggregate demand in the US either. It depends slightly on the form that investment would take. But the US is already running a large current account deficit. It's already experienced a pickup in investments. Aggregate demand is running ahead of potential supply, as evidenced by the current account deficit. So it's not clear that from a macro perspective, you would say that this would be a means to substantially faster growth on a sustained basis anyway. So I think the economics of this are a bit muddled. It misunderstands the political and geopolitical circumstances that we find ourselves in. And I don't, short answer being no, I don't think this is a viable policy solution.
You're talking about the health of the global trade picture. A big part of that seems to be what's happening with China and its current account surplus by extension. There was a real sense in that first Trump administration that, he came in and his approach to China had this sort of bipartisan approval. Finally, the executive branch is going to stop soft peddling Beijing on trade and get tough. And looking at where China's current account is now, wouldn't the quote unquote highest tariff in history on Chinese goods be welcome in places like New Delhi and Seoul and Kuala Lumpur?
It's clear we're not in the same place we were in, say, 2005, where the idea that China runs a big current account surplus, but so what? The world benefits from its cheap exports. We're clearly not in that place. And there is general pushback, not just in the US, but also in parts of Europe and indeed in other emerging economies to what are perceived to be state-subsidized exports from China. So in that sense, any pushback against China, I think, would be welcomed by competitors to China. However, I'd just caution that I'm not so sure that tariffs are going to make much of a difference in terms of China's export prowess. The US levied, at the time, significant tariffs on China in 2018. Since then, China's share of global exports have continued to climb. In fact, they're now at a record high. I think tariffs are a blunt tool. I think the economics that underpins this thinking is muddled and unclear. I do think there's a political push against allowing vast sums of Chinese imports, particularly in what are perceived to be strategically important industries. I think the most effective, if that's the concern, then the most effective way of dealing with that is through technology controls and so on and so forth that helped slow the development of those industries in China rather than tariffs, which frankly do not appear to have made much difference at this stage.
So how does the China surplus story play out? There's been lots of noise about stimulus coming out of Beijing last few weeks. Nothing so far that's really going to move the dial on encouraging domestic demand and absorbing all of that excess capacity. I know you've had lots of questions about this issue from clients over the past week. What has he been telling them?
Well, I think the way you framed it is exactly the right way to think about this. There's too much, particularly in the Western debate, about tariffs and what the US and others can do to push back against this perceived flood of Chinese exports. But there's not enough consideration of the situation from Beijing's perspective or the situation in China. And as I said earlier, at root, this is an issue about China's high domestic savings rate and the fact that that high domestic savings rate leaves it dependent upon foreigners to sustain demand. And that's the root of the current surplus. So if the question is, how will China's surplus play out? Then the answer is not to be found in the policies devised in Washington or Brussels or London. It's going to be in the policies devised in Beijing. And that's why the stimulus plans or policy support plans announced over the past week or so, I think, is so important. The essence here really is that there's not much to support domestic Chinese consumers, at least nothing concrete that we've seen yet. And this is the nub of the issue. Unless there is a shift in China's growth model away from high savings towards domestic consumption, then it's difficult to see there being a meaningful reduction in China's trade surplus and current account surplus. And so this is not going to go away unless there is a shift in policy in China to move the economy away from high savings and towards higher rates of consumption. Then I don't see a path towards a lower trade or current account surplus. And in that sense, I don't think this is an issue that's going to go away quickly with or without Trump.
I know you've got to run, but before you go, we haven't mentioned Kamala Harris. Very quickly, given all that you've just said about Trump's policies, about what's happening or what isn't happening with China on the reform front, with Harris, are we being complacent in terms of talking about her as a continuity candidate? How does trade evolve under her presidency? Would we see a big divergence from what was happening under the Biden administration?
I think some of this will depend upon the makeup of Congress after the election, but assuming that Congress remains split between both major parties, then I think it's fair to assume that a Harris presidency would represent business as usual for the most part for the US economy. While there's clearly some uncertainty, it's reasonable to assume there will be a significant amount of continuity when it comes to trade. And what that means is less of a focus on tariffs as a tool of trade policy. The tariffs that have been put in place will stay there, I'm sure, and more of a focus on things like controls on technology transfers to China. And as I said earlier, I think that they're potentially a bit more effective in terms of strangling the development of China's high-tech sector over the long term.
Neil Shearing there from the Emirates Lounge in Chet Blackcock Airport in Hong Kong. Excuse the occasional shonky audio, it's a downside of recording from the road. We're ratcheting up our coverage of the US election as we enter the final weeks. In the coming week, we'll have 2 drop-ins. Those are our short-form online briefings. They're going to preview the macro and market implications of this election. The first is on Tuesday at 10 a.m. Eastern, 3 o'clock UK time, and another on Wednesday at 9 a.m. UK, that's 4 p.m. Singapore, which will devote a bit more time to what this election looks like from Asia. I'll link to those and to our US election key issues page, which houses all the analysis you need to understand what this vote means for the US and global economies and financial markets, commodities markets, commercial real estate, and much more. Before the next bit, a quick shout out to our markets team, which was named most accurate forecaster of global stock indices by LSEG Data and Analytics for Q3. That was the 3rd quarter in a row that the team has won and follows them winning the inaugural annual award last year. One of their big insights has been the role that hype around artificial intelligence would play in driving S&P 500 earnings and valuations. Their end 2024 5500 forecast for the S&P raised eyebrows in the market when it was published last June. Since then, other forecasters have been scrambling to catch up as the index has risen to and beyond that level. The team raised its forecast to 6,000 in June, has a 7,000 target for the end of next year, so still very much above consensus. I will post their key report from January on what the market has failed to understand about what tech hype does to earnings and particularly to valuations on the podcast page. Now, as expected, the ECB delivered another 25 basis point cut at its October meeting on Thursday. What next? Is a 50 basis point move possible? And what about the state of the Eurozone economy? Chief Europe economist Andrew Kenningham and Deputy Chief Jack Allen Reynolds briefed clients in a drop-in shortly after Christine Lagarde's press conference wrapped up on Thursday. And here's an extract from that now. You'll hear Jack first discussing the feasibility of a 50 basis point rate cut in December's meeting.
No, I think one interesting thing when you look back at ECB history, so look back before the global financial crisis when the lower bound on interest rates wasn't a constraint and 50 basis points of cuts were possible. Actually, 50 basis point cuts were more frequent than 25 basis point cuts. To go back to the early 2000s, 1999 to 2003, there were 3 25 basis point cuts. There were 5 50 basis point cuts. Now, 2 of those followed the 9/11 attacks, but still, the point is that 50 basis point cuts are not particularly unusual. So we shouldn't be shocked if we get a 50 basis point cut at some point in this easing cycle as well. And if you compare the situation now to back then, well, the growth outlook is similarly poor. So when the ECB is cut by 50 basis points in the past, the inflation data are probably still a bit stronger, whether it's survey measures of selling price expectations or domestic inflation. Those indicators are still a bit stronger. But we're also in a different world in which the ECB does seem to be of the view that interest rates are still restrictive. They do seem to be still of the view that they know they want to keep on cutting. The question is when and how quickly. So I do think it's definitely possible that if the growth numbers remain weak and inflation continues, or at least core inflation continues to come down, that we get a 50 basis point cut maybe even in December.
Yes, I mean, Christine did stress that she was aware people would be looking very closely at the language that says the rates will be kept restrictive for as long as necessary and be looking for any change in that language. Now, and she also, I think, admitted that the time when it was no longer necessary for rates to be restrictive may have been moved forward, being advanced somewhat. So you could certainly imagine that they might conclude that they don't need restrictive policy within the next 3 or 4 months, in which case they'd have to get rates down really quite a lot because, there's a debate over exactly what the neutral rate would be, but I think everybody would agree that it's at least 50, probably 75 minimum below the current policy rate. That actually does bring us to another question which we had before the meeting, which is what we think the terminal rate will be for the ECB. I mean, the answer is in our forecast that it's 2.5%. So that's where we're forecasting rate cuts to stop. That's somewhat higher than what the market is currently pricing in. But I mean, I think we had good reasons to forecast that 2.5% terminal rate. Do you think that's now coming into question?
Yeah, I think it probably is. Our estimate of the neutral rate being 2.5%, we did a big piece of work last year, which is available on the website, where we outlined the rationale behind our estimate of the neutral rate being 2.5%. I guess there's 2 parts to the question. One is, how certain are we about the neutral rate? And 2 is, do interest rates need to go below the neutral rate? On the first question, obviously we can't be very certain about exactly where the neutral rate is. We have good reasons to think that it's higher than it was before the pandemic, not least because the cyclical forces that had been weighing on the economy and inflation before COVID are completely different now. The labour market's still quite strong, wage growth is strong. It seems like underlying price pressures are going to remain high for some time. And perhaps some of the structural forces that have been pushing equilibrium interest rates down before the pandemic have been shifting, and perhaps that long-term component of the equilibrium rate is a bit higher now. But then in terms of where interest rates need to sit relative to neutral, I think the risk is shifting in the direction that the policy might need to become accommodative. We've been more bearish than the consensus on growth for some time, and it's that seems like the right place to be right now. And then on inflation, we think headline inflation is going to average well below 2% next year and the year after. Now, big part of that is that we think oil and gas prices will fall, and so energy inflation is going to stay negative. But if growth remains weak, then it's perfectly possible that core inflation comes down more than we're expecting it to, and perhaps below the 2% target next year. So I think that's definitely where the balance of risk is shifting towards lower interest rates than we're currently forecasting.
Another issue that came up was whether there'll be a recession in the Eurozone. Christine Lagarde seemed to say several times there will not be a recession. I wondered if she was protesting too much about that and only going to fuel the idea that there might be a recession. Clearly, the outlook for Germany and France has deteriorated. It was already very poor when they together are nearly half of Eurozone GDP, I think. So I wouldn't completely rule that out. What do you think?
By most reasonable definitions, Germany is already in recession. Mm-hmm. France is not a million miles away, and with the fiscal tightening that looks like it's on the way, that could push France into recession conceivably. I guess the big thing that's been keeping the Eurozone away from recession is that the southern economies have been doing very well, particularly Spain. And our assumption is that will continue. The latest data from Spain and the other southern economies have been reasonably good. Spain in particular is benefiting from massive amounts of immigration, which as long as the economy, it looks like it's reasonably strong and the unemployment rate is low, that suggests that they'll continue to see high levels of immigration, which will push GDP growth up. But clearly there are plenty of risks that could cause the economy to weaken. And as I mentioned before, we are definitely on the bearish end of the spectrum already. I think if you look at all the latest indicators of household consumption and spending intentions, they're quite weak, even though real incomes are rising. The outlook for investment is also quite poor, both in the near term and say with construction, because the construction sector is still being hit by the relatively high level of interest rates, but also business investment intentions are quite weak too. And the outlook for exports, based on the latest surveys, we're not going to necessarily see exports decline, but we're not expecting particularly rapid growth either. So I think you look across the board, and the latest data that we're seeing are pointing to widespread weakness. So it wouldn't take a very big deterioration from where we are now to take the Eurozone into recession.
That was Jack Allen Reynolds and Andrew Kenningham on the ECB. In the session, they also answered a lot of client questions about fiscal risks in the Eurozone, namely around French deficits, getting lots of questions about that, and how the ECB could respond to those. I will post the full recording in the podcast notes, but you can sign up for an upcoming session and watch recordings of our past drop-ins on our events page, capitaleconomics.com/events. Finally this week, auto headlines have been dominated by reports of rapidly cooling sales growth of electric vehicles. On the surface, at least, that would point to the oil demand outlook not being as bleak as the initial hype around the EV rollout suggested. But that's not the whole picture. Hamad Hussein from our Commodities and Climate desk has been looking at the global sales data to get a sense of what's really happening. And what he found suggests that oil bulls shouldn't be getting too excited. I spoke with him last week, and here's that conversation now, beginning with his assessment of what's been happening with EV sales in the US and Europe.
To put things into context, for every 100 new cars sold in the US last year, about 10 were electric vehicles. The latest data show that this rate has remained flat. Meanwhile, in Europe, about 25 to 30 electric vehicles were sold for every 100 new cars last year. This year, that rate is closer to about 20 new EVs. Now, given net zero targets in the West, what we really need to see is the share of electric vehicles being sold to increase, not stagnate or even fall, which has been the case in Europe. In terms of why this has happened, survey evidence suggests that the cost of purchasing an EV remains a top concern for many consumers, as well as issues related to charging. In Europe, this hasn't been helped by the removal of subsidies for consumers and businesses buying electric vehicles in Germany. At this point, it's worth noting that well-designed and generous subsidies have been key to accelerating electric vehicle rollouts in countries such as Norway, where most new cars sold are electric-powered. So very much the key problem facing EV rollouts is that there's a lack of progress in addressing the key consumer concerns around the costs of electric vehicles and the cost of charging as well.
So based on all that you've just said, what's the outlook for sales? Where do they go from here?
Yeah, to be honest, the near and medium term outlook for electric vehicle rollouts doesn't look great. The clearest risks are political. Obviously, in the US, you've got Donald Trump, who on the campaign trail has promised to slash regulations and emission standards related to vehicles. Also, he has threatened to scale back the electric vehicle subsidies and tax credits available as part of the Inflation Reduction Act. But also in Europe as well, we've seen some of these political risks come to the forefront. For example, there's been a rise in support for parties that have campaigned on an anti-green agenda in elections, both in the European Parliament elections, but also in national and state elections too. So very much the most obvious risks to EV rollouts are political. Now, there's also economic factors at play. Fiscal constraints, particularly in Europe, means that there is little scope as well as little appetite to provide more subsidies and incentives to increase sales of electric vehicles. What's more, tariffs on relatively cheap Chinese-made electric vehicles will keep the cost of EVs higher than otherwise too on both sides of the Atlantic. In any case, slow economic growth in Europe may also be a drag on new EV sales too. But if we take a step back and take a look at the long-term outlook, vehicle emissions are set to be tightened and bans on new sales of internal combustion engine cars are still set to be enforced in Europe in the 2030s. And given technological progress, one would expect the cost of electric vehicles to become more affordable as it becomes more pressing to reduce oil consumption. So you put in this into simple terms, very much the near-term and the medium-term outlook doesn't look great for electric vehicles, but the longer-term outlook should improve and the prospects for EV adoption should brighten over the 2030s.
The other part of your analysis, you've got the US and European Union on one side, but on the other side is what's happening in China. And for all the headlines talking about, the end of EV sales in the West and it's all a lot of hype that's come to nothing, actually EV sales are booming in China, aren't they?
Yeah, so what we're seeing in China is almost the complete opposite. The EV rollout has really sped up over the past year, and this has been enabled by the huge expansion in manufacturing capacity, and this has allowed Chinese automakers to produce and sell electric vehicles at a very affordable price. To put some numbers on this, about half of all new passenger cars sold in China were electric vehicles in July. Now, to put this into context as well, the State Council had estimated that the share of EVs in new car sales would be about 20% by 2025. So China's running well ahead of even the State Council's expectations in terms of the electric vehicle rollout. It's not just electric vehicles either that's really gaining popularity in China. For instance, there's been a rise in the sales of LNG fuel trucks, which is hitting oil demand, given that truckers are usually very much heavy consumers of road diesel. So what we're seeing is the rollout of electric vehicles really hitting consumer demand for road diesel and for petrol, but we're also seeing other new energy vehicles hitting oil demand as well.
So booming sales in China, struggling sales near term in Europe and the US. Put it all together for us, put your commodities hat on. What does this mean for global oil demand?
So while the rollout of electric vehicles in Europe and the US has slowed down, and it may mean less oil will be displaced by these types of vehicles than many forecasters originally thought, it is also worth noting that there's been an increase in sales of hybrids, particularly in the US, as consumers navigate some of the uncertainty related to pure battery electric vehicles. Meanwhile, the pace of adoption of electric vehicles in China has been surprisingly quick, and it appears as though the rollout is really putting a lid on oil demand there. So even if there is a cyclical upturn on the back of all this policy support that's coming out of Beijing over the coming quarters, the popularity of electric vehicles in China may just limit any increase in oil demand growth. So bringing this all together, given the pace of EV adoption in China, and nothing in the US and Europe has made us change our mind on peak oil demand happening around the end of this decade.
Hamad Hussein on the EV sales outlook and implications for oil demand. I'll add his analysis and a link to our long-term energy scenario generator on the podcast notes. That generator is a really useful tool to track consumption by country and energy type out to 2050. Includes all of our forecasts for key energy commodities as well. But that's it for this week. We will be back next week with more of the big issues in global macro and markets, including a preview from our UK team of the October 30th budget. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.